We're in for, I think, a pretty good event tonight. This is going to be a conversation about what's going on out there in the world, some of the things and the questions that you have had. We were gracious, some of you were gracious enough to send us in questions, so we're going to cover those things. I do want to make sure that we cover as many questions as we can, but obviously myself, Nick, and David and the rest of the team will be available afterwards to have one-on-one conversations with you. So if you have those specific questions that maybe you think are a little too personal to ask, then that would be the time to cover those things. But we did get a lot of the questions from you. Tonight is about your investments, your retirement planning, some of the things that we know that you've put in place because you're here. Most of you here are our clients. And other things that we want to be thinking about because, number one, things have changed a little bit since last time we got together. Those of you that were with us at the winery, I think that was May or June. And also, things are probably going to change or remain a little bit dicey, shall we say, over the next, I would say, 6 to 9 months. So we'll cover some of those things. Just before we get started, I do want to point out a few things. So all of you have this little folder that we handed out. I just want to touch base on a few things that are in there. One is there's a little article on your 401k, or a little, I shouldn't say an article, but some comments on your 401k. We have the ability to help you with your 401k, even leaving it at work. So if you're still working, you have a 401k at work, we have a process and a system we've built out to be able to help you make sure that's invested the right way, even while that money stays inside that 401k. And so make sure, especially at a time like this, that you're taking advantage of all these services that we offer, because one of the worst things that can happen is you get, within a year or two of retirement, your 401k isn't invested properly. You don't think any financial advisors can help you with it because while you're still at your company, sometimes it has to stay there, not all the time. So we want to let you know that we do provide that service. So a good little thing there to read. We also have something we're going to cover a little bit, a few things that we're going to cover a little bit later, and I'll point to those things as we touch base on them. There's some note paper in here. Did everybody get a pen when they came in? Okay, great. So there's note paper in there to take notes on, and then a number of different things on inflation, which is obviously a hot topic these days. So we put those in your folder, not necessarily to read right now, but if I get really boring, you can go ahead and start reading those things. But also just to have something to take with you, because I would encourage you to take some notes tonight and be thinking over the next few days about some of the things that we talk about tonight. Also, if you have friends or family, I was talking to a couple folks out front here about family members, younger, grown children in their 30s and so on, that sometimes either don't have time to look at their own finances or they just don't want to talk about their own finances and so on. Some of the resources that we have available here and also on our website, direct them to that. It's a very non-threatening way where they can do some research. As you know, we speak real clean English here, real straightforward English. We don't, we don't make things so complicated. So your kids, your family, your friends can get a lot of information on our website without feeling like they have to have this personal conversation with you that's sometimes awkward. If your kids are like my kids, they don't want to hear it from me, okay? If it was my mom and dad when they were still alive, they'd listen to grandma and grandpa all day long, but I'm all of a sudden an idiot. I hope that maybe I'll get smart again about the time they get into their 30s, but right now they're a little bit younger, so they would listen to my mom and dad a lot more than they would listen to me. And for those of you that feel the same way, our website is a great place to direct folks to that you want to get some simple help. Also, those of you, there's a few of you who are not yet clients but have begun a process with us of getting to know us and so on. Those of you that are not yet clients, you should have in your little folder here a sheet that looks like this. If you would, we'd so appreciate it if you would just jot down your thoughts about the event on this sheet. You can write us a little note on the back, fill out the front so we know how best to serve you. And then if you feel, once I'm done talking here, that the timing is right to come in and just get a kind of another checkup, because I know we've, again, those of you that aren't clients, and there's just a few of you here, are sort of in the middle of this process. But if you want to, make sure that you're up to date, especially with what's going on, it's pretty crazy out there right now. You want to make sure you're not making any mistakes, then just go ahead and we do need to pick these up from you that aren't clients on the way out, so make sure you leave it on your way out. But in the meantime, jot us a note if you want to come in and visit, check off those couple boxes there. But make sure that we know what's important to you. By the way, those of you that are clients of ours and a few of you that aren't, one of the biggest reasons that we get the material, you see me on Channel 5 a couple times every weekend. I know you've seen David a little bit, you've seen Nick a little bit. One of the best ways that we pick subjects to talk about on that program are based on your feedback. We don't want to be out of touch and be talking about things that aren't important to you. And if you look around the room, okay, I don't want to kind of make any assumptions, but most of you are probably about my age. I just turned 60, so I see some of the ladies are probably a good 20 years under than that. But if you look around, we kind of represent, you and I sort of represent a lot. It's a concern of other folks here tonight. And so if I know something's a concern of yours, chances are it's a concern of other folks like us. So we really want you to tell us what you're worried about and so on. And that's why we ask you these questions on here. You can kind of check a box and let us know what you're thinking. Those of you that are clients, how many of you know about our ambassador program? Okay, so some of you are probably already ambassadors. We do a real special event every year for those of you that go out of your way to introduce us to family or friends. And here's what I was just talking to our advisors last week about this. It's really important that, when I go to my dentist, he has a little card, and if you turn over the back, it says, I heart referrals. Have you guys all seen that? Okay. And, I know that it benefits him a lot to give a referral. We do not ask for introductions for that reason. We ask for introductions because, unfortunately, in this day and age, and in the business that I'm in, and Nick and the team and David is, a lot of folks are getting bad advice. And so when you are gracious enough and trusting enough and have the confidence knowing that we're going to treat your friends and family the right way, sometimes what you are doing is saving them potentially. It doesn't mean all financial advisor firms are not doing a good job out there. I'm not saying that. But there are a lot that aren't doing a good job or just aren't doing a thorough job. And so for those of you that have already done that and those of you that would like to, we take it very, very seriously when you introduce somebody to us. We will handle them with great care. And then for those of you that do that, we do a real special event at the end of the year. Something pretty fancy. It's not like this. It's not cookies and milk out there. It's something really nice, somewhere that you might take a spouse for an anniversary or something like that. So keep an eye out for that. So there's a little brochure here that explains that. So let's get into the business of what we're here to talk about, which is a lot of things that are going on out there. And we want to cover a few points tonight. And so I'm just going to dig right into some slides that we've prepared. And later on, we're going to answer the questions, and then we'll just hang out, for lack of a better word, and make sure that you have time one-on-one to ask us any other questions that, again, you might not feel comfortable asking in front of a group. So, how many of you are lawyers in the room? Got to have a few attorneys, right? No attorneys? Nobody wants to admit it because they know what's coming, right? So you have this stuff, that attorneys put up. It basically says, don't leave here and take something I say and change something you're doing based on what I say, because your situation's very different than the person next to you. Make sense? So that's it. I don't know why it takes them, 150 words to say what I just said in 7, but that's how it works. So let's talk a little bit about the current state of the market. What's going on out there? The market's down a lot, right? I was checking statistics this morning, and so there's the NASDAQ 100. There are 100 large companies out there that are sort of the big technology companies, the fast-growing companies. So it's Apple. You have an iPhone, it's Apple. It's Google, where you search for information. It's Facebook. It's companies that make chips that go into computer games for us. It's companies that make cars or car technology. All the companies that we have appreciated that have really changed our lives for the better, for the most part. Most of these companies have changed our lives for the better over the last few years. Well, these companies sort of make up this NASDAQ 100. Those are the 100 companies, and they measure the value of those companies. Those companies are down about 30% this year, as an average, which means some are down a lot more than that. That is a pretty drastic downturn in companies that typically have done really well, and quite frankly are still doing very well. But remember, the stock market is kind of an indicator of what the big money expects over the next 6 to 12 months. And the big money clearly is expecting a slowdown in the economy. Now, the big money isn't always right. I mean, these are mutual funds and pension funds and endowments and so on that buy and sell stocks and invest for sometimes us as a group here inside our 401ks, sometimes very, very wealthy people. So the big money isn't always right, but clearly what's being anticipated is a continued downturn. Some would argue we're already in a recession. Apparently, certain politicians don't ever want to admit that, so we might be in a recession and never hear that we're in a recession, but there's some real challenges out there. So NASDAQ, the big growth stocks, those big quality companies that are great long-term investments are down quite a bit. Blue chip stocks are down quite a bit. My wife and I own some JP Morgan stock. Now, don't go and buy JP Morgan just because I said that, okay? I'm not telling you to do that. I'm just giving you an example. But JP Morgan Chase, which is one of the largest banks in the U.S., maybe the largest bank in the U.S., that stock is down from about 150 to I think about 104 today. So significant downturns. Have we sold any of our stock? Absolutely not. We believe in the company long term. We don't need the money right now. But of course, it's very hard to watch that drop, right? So we're in a very, very unique time right now when things that are valuable, companies that are valuable, companies that most of us do business with. If I were to show you a list of 10 quality companies out there, probably most of us do business with 7, 8, maybe all of them are discounted in value. And so it's a little unnerving, right? When we're in retirement and we see this happening. I'm going to walk in front of this. I shouldn't be doing this, but might as well say something about it. When we see that happening in retirement, it could be unnerving for some of us. Now, the good news is every one of you has sat down with Nick or David, one of our team, and you have this financial plan. And what I tell people is you don't have a good financial plan if every time something like what we're going through right now happens that you have to react to that. You should never have to react to something. Your plan was built for the next 10, 15, 20, 30 years. Okay? My dad retired at 65. He lived to be 84. That was 19 years in retirement. Anything that happened at age 67 when he was in retirement for 2 years, if he's reacting to that, he doesn't have a very good plan. So I'm not here discounting what we see going on out there. We're going to talk about some of the other ramifications there. But what I'm stressing, and it's really, really important, and believe me, I'm right there with you. I'm invested in all the same things you are, is I know it's uncomfortable, but we've got to kind of block out that noise that we hear, whether it's on the news or from friends of ours and so on, and just rely on that foundation that you have a financial plan, I have a financial plan, Nick does, David does, and we're there with you when it's challenging to see these things, but at the same time, we know how this ends, okay? And it ends 5, 10, 15, 20 years from now, and we're going to look back on this, just like today we might look back on 01 and 02, right? 20 years ago, and remember with a distant memory how that felt at the time, but hopefully we don't make mistakes during that time. So the markets are challenging. I'm going to step in front of this again here. Now, one of the things that we want to look at for next year, and we want to talk a little bit about what's going on next year, is 3 very important components, let's say, to your investment plan. And again, remember, you have a financial plan. The investments are tools to get to the end goal of your plan. A lot of times you'll come to these events like this. Hopefully you won't go to any other, hopefully you won't cheat on us and go to other financial planners events, but I'm not dumb enough to think that every once in a while, you might do that, somebody might do that. And what happens at a lot of those events, and I was talking to Nick and David about this a couple of weeks ago, is these other advisors, they just immediately start talking about investments, talking about stocks and bonds, talking about interest rates, and those things are all tools that help us get to where our financial plan says that we're trying to get to. You follow that? There's a big difference. The focus is the financial plan, the investments are the tools, okay? So we're going to talk about the investments, but keep that in mind. It's always about the financial plan. So over the next year, there are a number of things that we want to be thinking about as the markets, I believe, will continue to be volatile, all right? One is our withdrawal rate. If you are retired, are you taking money off of your investments? okay? And again, Nick and David and I, and we've got another big team down in Connecticut, we're always looking at this. If you're taking money off your investments, number one, are we taking the right amount? Number two, where are we taking it from? So sometimes in times like this, although your financial plan doesn't change, because maybe stocks and mutual funds are down, and your safe money that we put in insured accounts like index annuities have not gone down, sometimes we'll switch and take your income off of the annuity while the market has a chance to recover. So it's something behind the scenes that we're constantly looking at to make sure that if you're taking withdrawals, whether they're monthly withdrawals or quarterly withdrawals, you're taking those from the right spot. If you have questions on that, okay, or you're not sure, we a lot of things go on behind the scenes that you don't know that we're looking at and managing for your accounts. But if you have any questions, you just need a little reassurance on this, give us a call. Okay? Give Nick a call, give David a call the office so that we can explain to you why we're doing what you're doing in your particular situation. But we need to be very aware, especially over the next year, of this situation with withdrawal rates. Investment returns. I talked just a few minutes ago about investment returns. What do we expect them to be? I can tell you what I expect them to be. Nobody knows. I had a great conversation with a client yesterday. We were joking around, and then about 10 minutes in, he asked me, he said, Joel, we knew they started raising interest rates about whenever it was. Seems like it's been a long year, but maybe it was June, something in May or June. When you saw that happen, why didn't you just sell all stocks and mutual funds and just sit in cash? Good question, right? In fact, I think in the pile of questions I'm about to answer, somebody might have said that, okay? Here's the problem. One is nobody knows. The markets don't always act the same way when interest rates go up. They don't always go down over a long enough period of time where we can predict when to get back in. And the problem is when you get out, you've got to get back in at some point, unless you're going to just sit in cash and lose your money to inflation, because it just goes down every year as far as the value. You've got to be right twice, right? You've got to get out at the right time, then you got to get back in at the right time. So you've got to be right twice, when to get out, when to get back in. One of the worst things that can happen is that the first time you do that, you're right twice. Because now, instead of thinking you got lucky, which is what happened, you think you're smarter than everybody else out there. I promise you, I've been on the floors of groups like BlackRock and American Funds and Vanguard, and you're on a floor that's about 10 times the size of this, with about 300 people that all have 6 screens in front of them, and they all went to MIT or Williams or some school like that, that you are not, I hope you don't take this offensively, but it's unlikely that you're a better investor and know more about the markets than they are. And then what we're saying when we try to get out and get back in at the right time is that we know better than they do, okay? So I was talking to this gentleman about this who brought this up, and you know what? It's easy to look back and say, hey, May or June, the market was going to go down another 12 or 15%. Why didn't we get out at that time? But again, we have a financial plan. It's a 15 to 20 year plan. We're going to look back at this someday and say, thank goodness I didn't try to time it on the way out and time it on the way back in. So it's really important to remember that. So as far as long-term investment returns, here's what we expect over the long term. We expect if you have a diversified portfolio of investments that's supporting that financial plan that you all have, and we have some stocks and some what are called exchange-traded funds. Those are those ones that say iShares in your Fidelity account, and you have that insured piece, that insured annuity where you can't lose money. You have a nice blend based on your situation. Again, not everybody has the same blend. We would expect a long-term rate of return to be somewhere between 6 and 9%, okay? Because most of you are good savers, and if we just have a withdrawal rate of somewhere around 4% or so, 5%, and then we keep up with inflation by another long-term inflation rate of about 3%, you're going to be in great shape. You'll be able to give yourselves raises, you pass away, and if you want to leave money to the people that you love or the organizations that you care about, it's highly likely, not guaranteed, but it's highly likely that when you leave money behind, you'll end up leaving more behind than you have right now. So that is our projection. Now, when I look back over the last few years, people have done much better than that, because when times are good, People are going to do much better. But one of the most dangerous things that you can do as somebody that's a consumer of financial services and somebody that's exposed to up and down stock markets is get to thinking that the normal is this 10 to 12 to 14% rate of return. It's not normal. Has it happened, for some folks that are a little bit more aggressive over maybe the last couple of years? Yeah, maybe you've got 10 or 12%, but it's not normal. Long-term returns on the stock market are about 9%. And in order to get the 9%, it means you have to be 100% exposed, which means there's going to be times when your account balance drops by 50%. And most folks can't handle that. But I want to say that because it's important that you know that the investment return that you need, people that come to these are not bad savers. They're not horrible with money. The people that are horrible with money would never think about coming to an event like this. They would never think about working with a financial advisor. So just by kind of common sense, we know that almost every one of you in this room is a good saver, and you're probably a better saver than you ever needed to be. You probably ended up in a place in retirement where you had more money than you thought you would when you're in your 20s and 30s. So we don't need to win a game we don't need to play a game to try to win because you've already won. It's about preserving your principal, getting a reasonable investment return. Does that make sense? Okay, so it's another thing we think about. So we think about withdrawal rates, we think about investment returns, and then of course we think about portfolio volatility. Is there any adjustments that we can make to not necessarily get out of the market, to not sell stocks or sell those iShares, which are exchange traded funds and so on, and get out of the market, but make adjustments? And yes, there are. We buy a lot of outside research from very large organizations. Some of them you would know, some of them you wouldn't have heard of. And about 6 weeks ago or so, somewhere between 3 and 6 weeks, we made a significant change in the stock portion of your portfolios to basically go from more of a growth mindset to a value mindset. What do I mean by that? So this is how we manage for volatility. So what I mean by that is there are certain things that people will always buy no matter what's going on with the economy. And there are certain things that people will tend to only buy when things are going real good with the economy or things are going really good with their personal income. So what would be something that we would always buy no matter how the company's going? Diapers. There you go, Nick. Diapers. Nick knows about diapers. What else? Gasoline. Food. What happened with COVID? What was all the craziness that was going on at the beginning of COVID? There you go, okay? So there's certain things that we're always going to buy. So buying companies that make that stuff, okay, is going to tend to be over the long run safer than buying something like Tesla, where the cars cost $100,000, and that's going to be a purchase where maybe somebody says, I'll wait, all right? So it's different. Now, over the long run, a company like Tesla or Apple, right, that sells $1,200 phones might grow a lot faster. But again, when we want to preserve cash, it's going to be a shift to the portfolio. So if you look at some of our portfolios today, and I don't have it up here, but you'll see names like Procter & Gamble and Kimberly-Clark and Pfizer and Raytheon and just big solid companies that tend to do well, banks, over the long run regardless of the economy. And then when you see things sort of settle down and maybe we get out of the recession that we're most likely going into and so on, then you'll see us tilt towards those growth stocks. So we're always looking at portfolio volatility in the economy, but I want you to understand this is really, really important. We're not getting out of the market, we're making adjustments. And we're making adjustments based on smoothing out that rate of return for your financial plan. Does anybody know what your biggest enemy is to you being a successful retiree that has their financial house in order? Any guesses? It's you. Sorry to tell you that. But it's you and it's me, for me, because it's the emotional component that makes us behave certain ways. And I am not immune to it. Even though I'm in this business, I've been in this business since 1989. When it comes to mine and Wendy's own money, we get emotionally involved. I have somebody that I talk to before I make changes in my own personal portfolio. Why? Because I realize that I'm the biggest danger. We call it in the business blowing up. I'm the biggest person that has the potential to blow up my portfolio by doing the wrong thing at the wrong time. And so it's that behavior. It's our biggest enemy. And that's why we want you to know that we're here to talk to you, and sometimes we're here to talk you out of doing something that everything inside you is screaming to do. Does that make sense? Okay, so that's a lot about the market, expectations for this next year, and so on. Let's talk about 2023. So now we're in the next year. We're almost in the next year now. I think we may still see rising interest rates. The Federal Reserve is under a lot of pressure right now, to stop raising rates. The administration wants them to stop raising rates because we're coming up on an election year, so there's a lot of outside forces here trying to get them to stop raising rates. Certain industries would like them to stop raising rates. If you think about it, higher interest rates, it means my son bought a home in June. Thank goodness he got a mortgage locked in, because his mortgage would be twice as much now as it would have been back in May or so when he got that mortgage commitment, okay? So it's not good for the housing industry, these rates going up and so on. But there is a possibility, if we can't get this inflation under control, and I'll come back to that in just a minute, that rates might continue to go up. So we may see that, okay? If you were to force me to guess right now, I don't think rates are going to go up much higher. If they do, I think they'll just hold steady for a while, but they could certainly go up. So we need to be aware of that, and I'm going to put it down as an expectation for 2023 because it's such a probability, okay, probably a good 30% or so, that we need to be aware of that. So again, we're not surprised when that might happen. Economic slowdown, we're already seeing that. I think we're going to see it some more. There was a report in, I believe it was either Bloomberg or the Wall Street Journal this morning, that talked about even if rates stay the same, unemployment will probably go up. Okay? Now this is a two-edged sword, right? We're all affected by inflation, right? Everybody drove here tonight, right? Nobody took a rickshaw or a bicycle or anything like that. So we put gas in our car to get here. It probably cost us twice as much as it did 2 years ago, okay? One of the things that will bring down inflation is higher unemployment. It's unfortunate, but that's just how it works, okay? So it is a very high probability that when interest rates stay this low, companies stop hiring, they slow down the process, they stop building new plants, people that build apartment buildings and houses stop borrowing money as much. Some people get laid off. It will slow down inflation, okay? And it will, in addition to that, probably cause a little bit of an economic slowdown, okay? How are we doing? Are you guys feeling real cheerful right now? I'm giving you the bad news first, okay? So again, this is what I would expect for 2023, all right? These things right here. Again, I don't want you to be surprised. We always want to, plan for the worst and hope for the best. That's a lot better than planning for the best, okay? And being surprised when bad stuff happens. We're stewards of your money. We take it very seriously. Okay, what is inflation? Do I even need to explain this? Everybody knows, right? What did it cost for a gallon of gas 2 years ago? $2.39. What does it cost today?
Too much.
Who said $2.39? Is that what it was? Was it $2.39?
That's when Biden took office.
Oh boy. Okay, let's not. Remember the one-on-one conversation I talked about we could have afterwards? Okay. So let's say it was $2.25, $2.40. It's much higher, right? I mean, it's probably not quite a double, but it's pretty darn close, depending on if you use premium or regular. That's inflation. That's just inflation. That's how it works. And over the long run, we kind of want a little bit of inflation. We could have a whole hour discussion on this. You kind of want 1.5% or 2%. It's actually good long term for the economy, but these shocks like we're in right now are problematic. Okay. 3 ways inflation hurts consumers. We just talked about it. You have less purchasing power. If you have to pay double for gas, then you're going to have less money to go out to dinner, to go to the movies, something like that, okay? You have less savings. So people that are dependent on cash flow or mortgage rates or borrowing money to buy a car, when they have to pay more interest because of inflation, it's going to hurt their ability to spend money. And of course, sometimes we just have goods and services that don't happen anymore, right? Costs too much to build something, it's just not going to be built, and so on. So that's why inflation hurts us. Let's back up from that and we'll get to some good stuff, okay? That was the bad stuff, some of that stuff, okay? The good stuff. Here's an example of how we manage one of our portfolios. At Johnson Brunetti, we manage about 12 different portfolios, okay? I am not sitting at home or in my office picking stocks. We buy research and put the portfolios together based on the best brains out there, but with the highest factor, the most important factor being what is your financial plan. So this is kind of an example of how diversified some of our portfolios are. And here you have an example. We're about 2.8, or let's just call it 3% of this person's portfolio. This is one of our portfolios. Let's just call this portfolio number 5, okay, is in some cash. They've got about 30% bonds, government bonds, and so on. They've got about 63% or so of stocks or mutual funds or exchange-traded funds that own stocks. And they've got something called internal alternative investments, which sort of go up when the market goes down. It's kind of a nice seesaw effect there of a little bit. So this is one example of a portfolio. And the reason I'm showing you this is it just shows you the diversification. Now, for somebody that's ultra conservative, they probably wouldn't have this, okay? Or they might only have this for 20% of their money, and 80% of their money would be in a 100% insured account that can't lose any money. So there's this blending that goes on in our office, but I'm just showing you the diversification here, okay? Strategies that can prevent high inflation from impacting your portfolio. We're always doing this for you, but if I was doing this on my TV program on Channel 5 every weekend, I would be talking about the importance of evaluating your investments. Do they fit that financial plan? And again, this is something we're constantly doing for you, but here's the deal. If something changes in your life, we need to know about it. Okay? So if all of a sudden, obviously, you're going to tell us if there's a death in the family or a spouse passes or divorce or something like that. We need to know about those things. But even little things, Joel, I was talking to my daughter out in San Francisco, and we've decided to move out there, but it might not happen until next year. Well, we need to know about those things now, because we want to evaluate your investments to make sure that still factors in that need for moving to a place that might be a little more expensive to live in Boston. There might be some other demands, or maybe you're going to sell a house here and you'll have extra cash. We need to be prepared of how to invest that and so on. So it's very important that we evaluate your investments constantly, but one of the things we don't know is if there's a change that happens in your life that we couldn't anticipate. We're constantly diversifying your investments. We just talked about that. And we want to make sure that your investments are appropriate for your goals. So this is different than number 1 and number 2. Number 1 and number 2 pertain to, is there something in your life that changed that's sort of this outside force or something that we wouldn't know about? A death, a disability, maybe you're taking care of a parent that's old and can't take care of themselves anymore. Something like that, we need to know about those things, okay? When your goals change, we need to know about that too. If all of a sudden you told us that I plan on living on $10,000 a month throughout my retirement and all I need is a little bit of a raise every year to protect against inflation, and then you decide, well, wait a minute, now I want to live on $20,000 a month, we need to know that sort of before you call and you talk to Linda in our office or Chris in our office and say, hey, just make an adjustment and pay me another 20, double my income. Okay, that should be a conversation you have with Nick or David, and we get together and we say, okay, what's the best way to do that? And we're going to rerun that financial plan and make sure you can do that, because what you don't want to do is do something that's going to have you run out of money about 2 or 3 years before your life expectancy, right? Insurance companies call it the date you mature, okay? We don't want you to run out of money before the date you mature. So we need to know about those things if your goals change. Okay. This is something that's really important, and we used to talk about this a lot more than we do now, but all of you that have that financial plan, it shows that one-page plan, there's actually these 3 little bubbles on it, okay? And these are the 3 basic components to any investment. We have growth, we have safety, and we have liquidity, all right? What does liquidity mean? Easy access to the money, right? I can get to the money anytime I want. What does growth mean? These are not trick questions, by the way. Right, assets that will grow, okay? I want growth. I want to earn more than just 3% interest that I can get at the bank. I want it to go up by, 7, 8, 9% per year. So liquidity is the access to the money quickly, okay? Growth is, I want it to grow more than just sort of safe money. And then safety is simply, it's safe. My grandfather came over here on a boat when he was 16 from Norway. He worked in a factory all his life, never even had a high school education. I always tell people you make things way too complicated. If I ask for an investment manager down in Manhattan, what does safety mean? I'm not going to get a 1 or 2 word answer. I'm going to get this long, drawn out thing about interest rates and hedging and all this kind of stuff. What do you think my grandpa would say if I asked him, what does safety mean with your money? Can't lose it. It's that simple, and that's what we mean too. Okay? So there's 3 components here. Now here's the trick. You can only have 2 at the same time. Think about it. What's money in the bank? It's safe and it's liquid. You don't get any growth. Okay? If you go out and buy a 1-year CD today, you get 4%. Why are they giving you 4%? Because inflation's at 7 or 8. You're losing money safely. You're going backwards. Okay? But there's an example of bank money. It's safe and it's liquid. Okay? What about a stock? What does a stock give us? Growth. And what else? If I own a stock, can I sell it anytime the New York Stock Exchange is open? Absolutely. So I've got liquidity and I've got growth. Do I have safety? Nope. So stocks share growth and liquidity. They don't share safety. Okay? What about something like if I go in with a bunch of partners and I buy an apartment building? Okay? What have I given up if I own an apartment building? Collecting rent every month, right? Probably get some growth. I've kind of got some safety. It's not like bank money safety, but I own this asset, right? It's like your house. You own an asset. It might go up and down in value a little bit, but I don't have any liquidity. Can't get the money out right away. So you see how almost every investment, what about the annuity that you have? Almost everybody in the room has the type of an account that I have where you put your money in and it can't go down when things are bad, but when the market goes up, you get some interest, okay? You get some of the upside, but none of the downside. What's that? Okay? Well, we've got safety, we've got the potential for growth, and we've kind of given up some liquidity, right? It's like a CD. If you break a CD early, you're going to pay a penalty. Same thing with that account. So you can see how everything sort of focuses on these 3 things, but you can only get 2. When a financial broker, a stockbroker comes to you and say, we could get you all 3, they have somehow changed the laws of the universe because it doesn't exist. Okay, you can only get 2. And it's just kind of a nice simple thing, and if you look at that one-page plan, you'll notice on that one-page plan, these 3 bubbles are on there. You know, when Nick and David go over your investments and when we originally did the financial plan, you'll notice those 3 bubbles are on that plan because it's just a good concept for us to remind you of and for you to be reminded of, and you should have some money in each of those categories. You should have bank money for that short-term money, checking account or banking account or whatever. You should have some money that's invested for growth, and you should have some money that maybe you give up some liquidity to get safety and some growth. And here's one of those accounts that many of you have, probably all of you, which is that insurance company account. You know, let's take a company like Security Benefit, all right? I have some money with Security Benefit, where when the market goes up, it goes up, but when the market goes down, it can't go down. And that Security Benefit account is like this blue line, okay? This is the stock market. So let's say you just owned Apple stock. Apple stock, if you bought it in 2000, probably lost almost 50%. That Security Benefit account, that index annuity that you have, didn't lose anything. When the market goes up, it's not going to go up as much, right? My insured account isn't going to go up as much as the market, but because I didn't go backwards, I'm still ahead. All right? Now, eventually, okay, the red line gets higher than the blue line. The problem is this does not feel good, that doesn't feel good, and wishing I would have just left my money somewhere else because I'm never catching up never feels good. So there's an example right there of the different combinations of what I showed you before and why it's important that we all have that. Does that make sense? Any questions on that? Good. Okay. All right, we're going to shift gears here a little bit. Okay, I want to talk about estate planning. I forget who I was talking to outside that we talked about their estate plan, and they had an irrevocable trust and had a pour-over will, and they had put the house into their trust and so on, okay? It's really important that everybody has an estate. I shouldn't say that. It's really important that you have your own estate plan, because what if you don't have your own estate plan? Guess who's written your estate plan for you? The state where you're a resident. Okay? If you die without a will, Massachusetts has written your estate plan. They say who gets what money, how much taxes get paid. Okay? They say if you have 3 kids and they're all fighting over the money, they say exactly who wins the fight, how that's going to look. So you have to have at the least a will. You want to have something called a power of attorney that says if I can't make decisions by myself, I appoint somebody to do that for me. Because again, if you don't do that, it's the court. Your probate court's going to make those decisions and so on. So it's really, really important that you have an estate plan, and probably most of you don't need to have a super sophisticated one, but you should have something that involves some element of sophistication, probably a trust, probably somebody that can be appointed to make some decisions for you. Okay, probably some directives that say I do or I don't want to be kept alive on a machine. Okay, things like that. You want to have those things. You also want to have family engagement, all right? It's really important to talk to your family about money. Now, remember how I said my grandpa came over here on a boat from Norway? So there's a couple clues to this question I'm going to ask you in a minute, okay? Clue number 1, Scandinavian. Clue number 2, born around 1903. Here's the question. Do you think he ever talked about money with his kids? No way. Right? It's 2 strikes. The generation and the cultural appropriation in that particular family. Okay? Now my son Michael married Alyssa. Alyssa's last name is Valente. Okay? Do you think the communication style is a little different between the Norwegian descendants and the thank you, okay? Do you think its communication style is different? Okay? So Alyssa's family, they talk a lot about money. In fact, they talk about everything. Okay? Everybody knows everything. Completely different than our family. Okay? And as soon as something changes, they're on. So anyway, it's just not worse, just different, right? So this is getting a little bit better than it used to, but we need to talk to our kids about our money. You don't have to talk to about the exact amount. But Wendy and I have sat down with our boys and said, we've been very fortunate, okay? We have more money than we're going to need in our lifetime, and chances are that you will inherit some of that money. But I'll tell you what won't happen, and then we go through the estate planning that we've done, okay? They're not going to be able to go out and buy 5 brand new cars, right? They're not going to, inherit a lifetime membership to some, NetJet's private jet or something like that. That's not what we're going to do for them. So we've given them the fact that they're probably going to inherit something, okay? And that what we believe our beliefs are, and because of our beliefs and our values about money, we've set up some estate planning so that our values are going to continue on. But you've got to have those conversations. It can be as specific or non-specific as you want it to be, okay? And believe me, for most of us, our kids will not want to pay attention. Okay? You'll tend to have some kids that say, I don't want to know, Mom and Dad, okay? And other kids that maybe make assumptions or so on. It doesn't matter. I can't encourage you enough to have those conversations. We've got to talk about what our retirement is going to look like to our kids too. Where do we plan to retire? Got to clarify our wishes. Now, here's kind of a neat thing you can do. Anything you put in a will or a trust or anything like that, it kind of becomes legal. All right? And so, my mother-in-law, Sue, has these Hummels. Do you guys know what Hummels are? These little things? Okay, I didn't even know what Hummels were until I got married. So anyway, we got these little things. So she shouldn't put who she wants to get the Hummels in her will. You know why? Nobody wants the Hummels, okay? But anyway, even if somebody did want the Hummels, she shouldn't put that in a legal document. She should just write out a separate list, right? Just write out a little separate list. So you can do that. You can say, hey, I want so-and-so to get the guitar and so-and-so to get, this and that and so on. You can do that without making it this formal legal document, because if you put it in a will or a trust, now you have to change it, all right? So clarify those wishes. Bring your kids in to meet with your professional services team. We want to meet your kids. Now, we did an event just like this a few years back, and we said, everybody bring your kids, okay? How do you think that went? Okay? You didn't do a good job bringing your kids. Your kids didn't want to come. Nobody came, all right? So we had a lot of food to take home for the 5 of us to split, all right? So I think after we learned that lesson, and I could appreciate it, because how old are your kids? I mean, they've got busy lives. They're trying to keep up. They've probably got kids that are at, sports and all that kind of stuff. So I get it. But we should, at some point, get maybe 1 or 2, if you have children, or somebody that's sort of this trusted person that we can at least meet so they have a face to put to a situation where if something happens to you, it's not the first time that they've met someone, okay? I'll just use myself as an example. If something happened to me and Wendy, okay, I would not want my kids, say I wasn't in this business and I had a financial, let's say I wasn't in this business and Nick was my financial advisor, okay? Something happens to me and Wendy, okay? Or maybe another example is something happens to me and Wendy's never met Nick. That's not a good situation, okay? Wendy's just lost me. She probably doesn't understand all the money in the first place. And now she doesn't know whether she should trust Nick, because after all, Nick's got a shaved head and a beard, and he dresses better than anybody else in the firm. He looks very sharp, so you just don't know, okay? That's not good. Wendy should have met Nick ahead of time, okay? And if something happens to me and Wendy, one of our kids, at least one of our kids, probably Noah, because he gets the most about money, should at least have met Nick. And maybe every year or two have a conversation with Nick. It's really, really important. That's when people get taken advantage of, when those things happen and there's no relationship already built, okay? And all of a sudden, okay, your kids knew that you worked with Johnson Brunetti, okay? But your kids, one of them plays golf with somebody else who's in real estate and hit it big last year, and all of a sudden your money has been turned over to somebody who wants to build a shopping center in Plymouth. And you don't want that, okay? So it's really, really important. I know I'm going on and on about this, but I can't stress enough how important this is. Okay. Trusted contact. Trusted contact is somebody that you can put down. There's actually a form that we have that says we're allowed to speak with that person for a number of reasons. One reason would be you disappear. You decide you're going to travel across Europe and stay in youth hostels. We don't know how to get a hold of you. There probably should be some way or somebody we can get in touch with to be able to have a conversation with, that we have permission to have a conversation with. Not necessarily they can make decisions for you, but we can have a permission to talk to them. The other thing is, if, not a pleasant thing to think about, but if at some point because remember, we're fiduciaries, right? We start to get the sense that maybe you're not making decisions quite as well as you used to, okay? Maybe all of a sudden somebody called you on the phone and you're about to invest in some oil well in West Texas and things like that. We can have somebody to talk to say, hey, just go check on them, make sure everything's okay, and so on. Trusted contact could be a friend, could be a relative, it could be your attorney, it could be your accountant, it could be one of your kids, but we're stressing this, and we've even got a form that we've gotten a hold of where we can have you fill that out. And again, it's not somebody that can necessarily make decisions, just somebody to make sure that we have somebody to talk to you. Okay? All right, estate planning. So here's my situation. Again, I want to kind of walk through estate planning situation. So we've got, step over here so I'm not in front of you. So here's me and Wendy. So this is 5 years from now. okay? So here's me and Wendy. Here's our 4 boys. This is the ages they'll be 5 years from now. Okay, we got Brandon that lives over in Tewksbury, and he manages an auto facility, auto repair place. We've got Michael, who's in the Marine Corps. He's married to Alyssa the Italian, Alyssa Valenti, okay? A lot of volume over there at that house. And they have our first, I'm going to get in trouble with some of the Italian folks here. And they have our first grandchild, Denver, okay? And so here they are. And then we've got Joel. Joel works for the Hartford Insurance Group. And Noah, who works for a financial firm. Don't ask me why he doesn't work for this financial firm, but he doesn't. Didn't want to come into Dad's business, so, which actually I kind of commend him for. He didn't want to be one of those kids that nobody knows how to treat because they're the boss's kid. So I appreciate that. And so here they are. Now, what could go wrong estate planning wise? Let's think about what can go wrong. Now, some of you moms are going to pick up on something right away. What is it? I'm surprised nobody got this, okay? What happens, I don't even like talking about this, but what happens if Michael and Alyssa split up? Okay? If I don't have a good estate plan, it's very possible that some of the money Wendy and I have saved end up outside of our bloodline, okay? Now, if we want that to happen, that's fine. There's nothing wrong with designating that happens, but we want it to be our choice, okay? See Noah here? Bright kid, likes fast cars. What happens when he comes home for the holidays and he drives in one of my cars and he gets in an accident? Who shows up first at the accident, even before the ambulance? The lawyers, okay? What are the lawyers going to see? He's driving my car. What's going to happen? Lawsuits, all that kind of stuff. So that could go wrong. That's not good. The other thing that might happen with Noah, and I love Noah. He's probably the most like me of anybody, of any of the other kids, okay? The day before the dirt is being put on my coffin, there will be a BMW in the driveway. I promise you that, okay? So one of the things that an estate plan can prevent is from that happening if we don't want that to happen. So again, it's kind of funny to think about this stuff, but we want to make sure we have control, we want to make sure we protect those assets, and we also want to make sure that taxes and probate have been thought through, okay? All right. How many of you guys have ever plans? You've taken us up on this. Pretty cool, huh? Pretty neat. We have paid for this for you. It is not free. We've paid for it. This is a repository, totally secure, digitally protected, where you can put documents into it. All right? Could be will, could be trust, could be your account statement once a year. Any number of items, you can put documents into it, and you can allow people that you know to have access to it, and you can have different access levels for different people. So if I know that Noah understands money, I can give him access to all of our stuff, all of our documents, and maybe I just want the other kids to only have access to certain things or them to have no access at all. I can do that. It's a really neat thing. We paid for it for all our clients. Cost us a lot of money. Take advantage of it, all right? Lori, how do they do that?
There's a sheet in their folder,
Okay.
all about it, and then they can use contact us and get them a
Okay, all right, everybody hear that? There's a sheet in your folder. Sheet in your folders, find it. You don't have to find it now, because then you'll stop listening to me, and I'll be really hurt. But a sheet in your folders, fill that out, and we'll set it all up for you, okay? And I just explained all the benefits there, okay? I mentioned earlier, 401k. If you're still working, you have a 401k. All right? Now, if you can roll over that 401k, you probably should. You'll have more control and better investment choices. If you can roll over the 401k, even if you're still working, many of you can do that. But some of you can't do that. We can help you with that. We have a system, all right? It's a system that's been built where we can help you manage that 401k without rolling it over, all right? And it's called RMS, Retirement Management Systems, and it's pretty neat. It'll give you an analysis on the risk that you're taking. It'll make adjustments, okay, on our behalf with our input, and we can go right in there and manage your 401k for you. Okay, let's cover a few questions, and then are the snacks still out there? That's what I'm thinking about. Okay. Yes, we do. Okay, so let's cover some questions. All right, so here we go. So, a question from, I won't use the names here, but question from somebody in this room. It says, I just read Warren Buffett has $75 billion invested in treasury bills. Although I have nowhere near that amount, should I consider putting some of my zero interest money into that vehicle? So, remember the pie chart I showed you on our portfolio? Some of that money is in treasury bills. So you don't have to worry about that. We've already done that for you. Also, it's a little bit, they're not telling you the whole story here. Warren Buffett currently has $75 billion invested in treasury bills because he controls insurance companies. And the biggest investment insurance companies have are bonds. Treasury bills are government bonds. They also buy corporate bonds. So if you look at any giant insurance company, think Prudential, let's take for example, 80% of their money is invested in bonds and a huge chunk of that is treasury bills. So it's a good question, but the example's a little bit, you're not quite getting the whole story. But we are doing that. So based on the design of your portfolio, whether it's an insurance-based principal protected account or whether it's in one of the portfolios, it's unlikely any of you don't have some exposure to treasury bills. And by the way, just to explain, a treasury bill is a short-term government bond. So right now you'd probably be earning somewhere between 3 to 4% in a treasury bill. Okay, considering the financial crisis we're in right now, I can only say that I am happy that Johnson Brunetti has my accounts. I'm not making this up. This actually says this right here, okay? It's not a crass commercial promotion. So that's very nice, so thank you. And we're actively trying to keep losses to a minimum. Do you have any financial Valium to pass out to us? It's actually what it says. I don't have any Valium. Valium. There may be a physician or two here. I won't point them out, so you could ask them. But we kind of talked about that at the beginning, right? We talked a lot about what we're seeing out there now and how sometimes you have to kind of shelter yourself from the noise. But I would not recommend pills to do that. Okay, I'm trying to figure out if and when to sell my house, and I'm wondering if Joel might have any advice about the tax ramifications, timing, whether to buy or rent afterwards. All right, so just a couple things real quick. If you are selling your primary residence, okay? So this isn't the vacation home, this isn't the cottage that's in the trust and so on and so on. Your primary residence. All right? If you lived there for 2 out of the last 5 years, now that gets kind of complicated and most people don't move. So let's just pretend that you are still living there now and you want to sell that. Most or all of the gain will not be taxed. Okay? So, and again, talk to David and Nick about the specifics of that. But as far as tax ramifications for most of you, the gain, the capital gain or the profit you take on your primary residence, a significant amount, if not all of it, will be untaxed, okay? And why is it 2 out of the last 5? Well, here's why. Let's say you move to another state and you live there for 2 years. You could still sell your residence here that you used to live in as long as that period of time hasn't passed. You guys get that? It gets a little complicated with the math, but you want to make sure you talk to David or Nick before doing something like that. So the taxes aren't as bad as if I just sold an investment. Whether to buy or rent afterwards, that really depends on your personal situation. I will tell you this, most of you that own a home in here, if you add it up, and some of you have done this, all the money it costs you to own that home, taxes, maintenance, unexpected things like that, you would be shocked at how much you're paying just to own that home. Now, it's an asset. Over time, it probably will appreciate in value, and it's unlikely it'll go down in value over a long time, but it costs you a lot of money in what we call carrying costs in the investment world to own that home. And so what some clients have actually done, they say, well, wait a minute, if I sell my home for, let's say, $500,000, just keep math easy, okay? I might have been paying $20,000 a year just to own that $500,000 home, right? So there's $20,000 I put in my pocket. Plus I can invest that $500,000, and let's just say at a conservative level I get 4% interest, that's another $20,000. by investing the money, but I'm not even spending the money, right? So I take this $500,000, sell the house, put it in an account, get $20,000 of interest off of that. Now I have the $20,000 I didn't spend anymore because I don't own the home anymore. That's $40,000. What could you rent for $40,000 a year, or about $3,300 a month? For some people, they're making that decision that 20 years ago people never would have made, right? Because we're all supposed to own the house and pay it off as quick as possible, right? But a lot of retirees are renting. And when they want to go somewhere, they just lock the door and they leave, and it's the landlord's problem. And you all know that there's these beautiful communities that have grown up all over the place. So that's an individual decision. Now, my mom and dad, if I would have showed them on paper how it made sense to sell their home and rent, what would their reaction have been? I don't care what that paper says, Joel, we're never doing that, okay? So this is just as much a personal decision as it is a kind of this analytical decision. But it's a great question. It's a great question. Okay, we have We have estate planning documents. What do we need to do as far as real estate trusts and so on to protect what we have if assisted living or long-term care is ever a factor? So a couple of things. A real estate trust is a type of investment. So I think what the person meant by that is, should we set up a trust and put our real estate in it, all right? But if you have good estate planning based on your financial needs, and again, Nick and I and Dave, we can review it for you very, very easily. We're all very well educated and versed in all the estate planning techniques. We just won't draft legal documents for you, but we've all been trained to look at the planning and so on. You probably should have covered protection against nursing home. Okay? You should have covered, should I put my home in a trust? All right? How am I going to pay for long-term care? That should all be part of a good estate plan. So whoever's asking this question, I know who, I'm just not going to call the person out. If you feel like that wasn't covered, have a conversation with us. Chances are it was, if it was a good estate planning attorney, but you should have the confidence to know that that was covered. Okay, what are the most important issues that we should know about Medicare? I guess the biggest thing is, you want to be aware of where you're taking your income from, because sometimes you can reduce your premium depending on how smart you take your income off of a portfolio. And I'll just give you a big example. Let's say I have $100,000 in a bank and I have $100,000 in a retirement account. If I take money out of the retirement account, that all gets taxed, and that can influence what I pay in Medicare premiums. If I leave the retirement account alone and I spend the money at the bank, I'm not earning anything at the bank, so that's not really hitting my income tax return, so it's not going to influence my Medicare premium. My Medicare premium might actually go down. So I would say the biggest thing to think about with Medicare is, how can I influence my premium? Because the premium is different based on your income level. Sometimes there's no way to avoid paying a higher premium because you're getting a big benefit on the investment side. You're just going to have to pay a higher premium. But that's what I would say. The other big factor is, should you have what's called an Advantage plan, or should you have traditional Medicare? Okay? And one of the reasons why, some of you know that we partnered up with a larger nationwide firm, one of the reasons why we did that is to be able to offer Medicare, because chances are we know you and your financial situation a lot better than some, whether you're buying Medicare online or working with, somebody that just specializes in Medicare. One of the reasons we wanted to do that is so we could help you make this very important decision, which is, should I buy Medicare Advantage or should I buy traditional? How many of you know the difference between the two when I say that? So most of you that are on Medicare know that. One's kind of a private, it's not really private, but one's a little less hooked up to the traditional government Medicare plan, which is the Advantage plan. But again, one's not right or wrong. It depends on your situation, and also a lot of the type of health care that you need. Okay, couple more here, and then we'll wrap. How many of you remember who John Mattis was? General John Mattis, wasn't it John? James Mattis? Everybody know who he was? Real tough Marine. I like the guy because my son's a Marine. So this person asked the question, what keeps me up at night? Anybody ever remember when one of the congressmen asked General Mattis that, what he said? He said, nothing keeps me up at night. I keep other people up at night. Anyways, What keeps me up at night? Not a lot. Unless I eat too much food before I go to bed or have too much sugar. But other than that, I don't have a lot of investment worries or concerns. And I say I don't have a lot. I mean, I can't tell you that, it'd be nice if the market would go up 4 weeks in a row, so it'd kind of start getting back. But that doesn't keep me up at night because I've been doing this since 1989, I think I just have a real good long-term perspective. Now, I will tell you this. If Wendy and I hadn't pretty much saved 20% of our income for the last 30 years, a lot would be keeping me up at night because I would be hoping that our poor savings habit could be bailed out by taking a bunch of risk in the stock market. So if I'm trying to play catch up and I'm taking a bunch of risk, a lot would be keeping me up at night right now because that's my only plan for retirement security. That's a problem. But because we're just such good savers, we're probably in a boat that a lot of you guys are in where you just need a reasonable rate of return. So I don't lose a lot of sleep at night, but it would be nice once in a while to see, my statement at the end of the month not get hit a little bit like yours is, but we're all in the same boat here. And it'll get better. It always has. I already answered that. A little question here about fixed income investments like CDs and treasuries. Rate of return, should we sell our stocks and buy those CDs and so on. So again, if you've followed our advice on that financial plan, I would not sell something to buy CDs and so on. But if you have money that's sitting there not earning anything, we have access to all CDs across the country. I mean, if you want a 4% CD, we have a 4% CD. But don't sell something out of an investment portfolio we've built for you to buy that CD, because again, what you're doing there is you're trying to time the stock market, which doesn't matter how smart somebody is, sooner or later they're going to be wrong. And usually they're wrong big. But if you have money sitting somewhere that's just not earning any money, give us a call, talk to Nick and David. We helped somebody with a CD today, and they got, I think, 3.95% or 4%, something like that. So that's all available to you. But I would not change your investment strategy, because remember, this is probably a very short-term thing. Okay, I think that is about it. Question about recession. I think we're probably, in a recession. And by the way, the market expects that. That's one of the reasons why the market's kind of bad right now. Question about I-bonds. You guys have all heard of I-bonds. They're these inflation-protected government bonds. So if inflation's at 8%, you might be able to buy an I-bond and get 10% interest. For how many of you does that sound exciting? Why not? You can only put $10,000 in. Right? So I'm not saying don't buy an I-bond, but again, put $10,000 in an I-bond where you can earn 5% more. You're earning $500. $500 is nice, but you can't put $100,000, $200,000, $300,000 into an I-bond. An I-bond is actually something pretty cool to give to a child or a grandchild or something like that.
What's the holding period on that?
Do you know what it is, Nick? I think it's a 6-month hold.
Yeah, they renew
They renew every 6 months, yeah. And you have to buy them direct. How many of you have been on like the Social Security website or the government healthcare website? No? How'd that work out? No, I shouldn't say that. It's not that bad. But you do have to buy them direct from the Treasury. You can't get them through us or through, Vanguard or Fidelity or someone like that. Good. I think I have covered everything. So let's see. Last but bear with me for just a moment. I want to make sure that we cover a few things. Lori, what am I forgetting here?
Nothing, just go through the seven resource table, money, wisdom, and mind.
Perfect. Okay. So we have an event coming up. We do this event every 6 months. We have another event that we're going to be doing. Some of you joined us at the vineyard, at the winery earlier in the year. That's something we call our Money, Wine, and Wisdom event. Okay, so there's always wine involved. There's a little clue there. And we're going to have another one of those coming up. So I believe everybody here has gotten an invitation to come to that. It's coming up in about a month. So please join us for that. It'll be fun. It won't be like this. I won't talk this long, I promise. It'll be much more of a social event where we can enjoy each other's company. I will give you kind of an update, but it'll be real quick. And also bring a friend. Bring some friends. It's not quite this formal. It's a nice night where you can enjoy dinner afterwards or beforehand and get together for us for the money, wine, and wisdom. Also, I mentioned those blue sheets. Those of you that have those blue sheets in your folder that are sort of in the process but not quite officially clients yet, please turn those in to the ladies at the back. We have, in your folder, you have a little referral sheet. So it looks like this. I have a book. Most of you have gotten it. If you haven't gotten it, by the way, let us know. We'll send one to you. But it's called the People's Retirement Handbook. And it's the book that I spent the most time writing out of the 9 books. And it does 2 things. One is it talks about financial concepts from the standpoint of Wendy and I, when we got married, and all the things that we did personally with money. And now that we're getting to that close to retirement age 60, all the lessons we've learned about money. You know, and when to buy insurance and when not to, and how to start a 401k and all that. It's kind of an interesting read, but you'll learn a lot of lessons about investing and so on through that. We also give you a peek behind the scenes of how a financial planning business works and what a lot of firms won't tell you about stuff that goes on behind the scenes. So if you want us to send that book to somebody, fill out this form. We'll be glad to send it to them. If you don't have a copy, let us know. We'll be glad to get that to you. And then there's a number of different resources that are available on the table out there. So as you're leaving, check out on the table. There's a number of there's a piece on a retirement journey. There's about having a family meeting that we talked about earlier. There's something for folks that pretty much believe they're ready to retire, but they're not quite sure. I was talking to somebody out front here. She had just retired, and she's kind of wondering if I should have. So there's some neat resources on that. So make sure you grab some of those resources out there. And I believe that is it. Am I forgetting anything else? So thanks for joining us tonight. We appreciate it. Hang out for a little bit and talk to us. All right? Have a good night.